whether they're going to sell grandma's house that they inherited in California or their primary house in California and cash out of that equity and bring to Montana. How do they preserve as much of that equity as possible, or a business that they're trying to sell?
What would you say the biggest secret to understanding what is happening with the amount of wealth accumulation, and people looking to preserve that wealth, and for the circles that you're running with and the clients that you're serving? What's the biggest thing that, if people are trying to capture like what's happening in Montana, what would you say that is?
Well, it goes hand in hand in what's happening in Montana and also nationally. You've got 10,000 baby boomers turning 65 every single day, and this massive collection of inheritance that's happening. So regardless of what's happening in the economy, going up and down, you're going to have this continued influx of capital into boomers to millennials who have cash, and typically that cash will go into certain things like real estate investment. So whether they're going to sell grandma's house that they inherited in California or their primary house in California and cash out of that equity and bring to Montana, how do they preserve as much of that equity as possible, or a business that they're trying to sell, and vice versa. We have a lot of families that have been here multi-generational in Montana that are looking to sell, and they're sitting on a basis that's massive, and a farm that their great grandfather bought for a donkey and a bottle of whiskey is now worth $20 million. And how do you navigate that? And how do you avoid or defer some of these tax implications?
Yeah, so let's focus on the first part of it, right, which is capital gains tax, and then we'll talk about estate tax, which is, I feel like, the elephant in the room.
Yeah.
So what are they looking at here, Chad, when it comes to, state, federal, approximately how much tax are these baby boomers, if they're going to be selling some of these houses in California or other assets in different states? What's kind of the amount that you think they might have to face in tax?
Well, depending on which state, but and what type of asset we're talking about, whether it's straight a primary residence or a business, and there's partners. So you can, and depending again which state, anywhere between 30 up to high 40s.
Yep. You
Yeah.
nailed it, right? And the depreciation capturing can push it to 50 as well. And there's state, federal, and then there's the Medicare Obamacare tax, right? That's been added on for investment property. So depending what nature it is, and so that's a big amount, right? And so if you could exit and defer that, so walk us through the Deferred Sales Trust, and for our listeners or someone who's watching this with you for the first time, um, how does it work? What is it, and what's some of the benefits for it?
Well, in the deferred sales trust, we look at it. Typically, what happens is the client will come to me and hizzy and say, we're thinking of selling this house, where we've been in this house for 5 years, and we bought it for $1 million, and now it's worth five, and we can't walk away from that type of offer. But we there's no other property around here because there's no supply, and so then we can't 1031 it. So, oh my gosh, what do we do? Do we put it in rental properties? And there's this limiting time frame that you have on the 1031, and that just seems to be the go-to for everybody that has that type of money. And typically, whether that's from their own experience, or from their financial advisors or CPAs that are saying, well, let's look at the 1031. They never look at the deferred sales trust because typically they don't know about it or aren't educated on it. So on a very high level, if we have a $4 million house, the person, instead of having to meet these time restrictions on the 1031, we can put them into a deferred sales trust, which is a third party, which will, the asset will be put into the third party trust, which simultaneously will be sold to the buyers. And then an installment contract is really what's going on here. And when you break all this down, this is essentially just a seller's carryback contract, which these types of principles have been around for 30 plus years. And I think the IRC 453 tax code that deals with this has been around for 90 years or something like that as
You
well. So
nailed it.